Today we had an unprecedented 3-hour outage on the Nasdaq, one of the biggest exchanges in the US. Trading resumed in the afternoon, but certainly the entire incident left its mark on wider markets. Here with me now is Arash Massoudi from the Financial Times. Arash, can you give us a bit more detail about what exactly happened today?
It was a very interesting day today on what had otherwise been a very slow and average August trading day with many traders out on vacation and the New York market's very quiet. Shares in some of the country's largest companies, including Apple, Google, Facebook, Microsoft, which all trade on the Nasdaq, essentially stopped trading as of about just after midday, and that lasted for about 3 hours and 10 minutes until Nasdaq restored a problem that it had with its software.
Now, today's glitch comes hot on the heels of another incident that took place this week, this time at Goldman Sachs, where hundreds of thousands of options contracts were mistakenly sent to the exchanges. Are we starting to see a bit of a trend in terms of technological glitches on Wall Street?
This week's events certainly will raise those questions. We've seen several trading blowups in the last few years. Among the most famous ones, the flash crash in 2010 when the Dow plunged quickly only to recover shortly thereafter. Knight Capital, of course, had its trading incident a year ago this time, and Nasdaq and BATS have also seen initial public offerings go quite badly on their exchange. So we are seeing a string of incidents that definitely raise these questions.
What do you think this says about the general U.S. market structure?
Well, it's an interesting debate, and there's definitely been vocal critics over the last 2 decades as the market has become more computerized. Trades take place at millisecond speeds with very sophisticated algorithms, and it's not just high-frequency trading firms using this, but brokerages across the market. And there's been a lot of discussion over the fragmentation of the U.S. market, where there's 13 exchanges and over 50 alternate trading venues, as they're known, where all these trades take place. So it's certainly not a centralized system, and there are arguments that this has had negative effects on the way stocks are traded.
Given that this issue has such a big impact on Wall Street and also on retail investors, do you think we're going to see a response from the regulators?
Well, we're still waiting for an official response from the SEC, but their attitude towards these developments in the markets over the last 2 decades has been that it's generally been a positive development in that trading costs have come down for retail investors as a result of inefficiencies in the market being squeezed out and spreads tightening. But whether or not they come out more strongly after this unprecedented outage